All right, thanks for joining this module. We're going to look at Vega. So Vega is the third primary Greek. Again, lots of other Greeks, but this is the one that I think comes into play fairly regularly and something to be well aware of. So Vega measures something we call volatility risk or implied volatility risk. In other words, if implied volatility changes, and we're going to come back to that, what that means, because that's a thing too, right? So if implied volatility changes, what does that do to your position? What does that do to your P&L? What does it do to your other Greeks? So the first thing, though, in order to understand that, is we need to understand implied volatility. So we looked at the three main Greeks, and this one here, it measures sensitivity, and it could be in either direction, just like with delta and theta, of your position to implied volatility. All right, what is implied volatility? Because that's a lot of important words. So implied volatility is really, it's what the market thinks. In other words, there's all these traders out there, there's institutional investors, and they're buying and selling options and securities, and when they, based on what they're doing, which options are they buying, how many are they buying, how fast are prices moving, they're basically saying something about where they think the market will go. So, for example, let's say that we heard that, oh, hey, we're going to have inflation. Well, guess what? People might start buying inflation hedges, maybe the types of stocks that are consumables. They're going after Procter and Gamble, and they're going after those kinds of things. Or we hear that, hey, there's going to be oil shortage. Well, guess what? The price of oil is going to go up, so people start buying Exxon or stocks that might benefit from that or not. They might start selling them short. They might start buying put options if they think they're going to go down. So those types of things that happen in the market, they tell us things about what the rest of the market thinks. If people hear things, we talked about this, by the way, in the, if you remember, there was the video about how options change in value, and it's worth probably reviewing that because I think it's fairly short if you don't remember it. But one of the things we talked about is, let's say that Apple came out with a statement that something bad was happening. They couldn't get component parts, or maybe one of their designs had a big flaw. Well, all of a sudden the price of Apple, it could go, there's investors thinking this could go south. So all of a sudden they start buying up put options, and they're buying basically protection because they have a big Apple, especially institutional investors. They might have a very big position in Apple, and so I need to protect it. So buying put options is one of the cheapest ways to do that. Well, those types of things happening in the market create something called implied volatility. In other words, it's not real volatility, it's not actual price movement, it's just prices telling us that investors think in the future price is going to move a lot. There will be volatility. And so implied volatility is a way of measuring that. It's putting a number on how much the market thinks things are going to move. Now, it shouldn't be confused with, and pay attention to this second paragraph, historic volatility or statistical volatility. In other words, actual volatility, right? There is actual movement. There is prices moving up and down, standard deviations, and there's actual statistical volatility. But that's what actually happened in history. It's what happened backward looking. Implied volatility is forward looking. And so we'll talk a little bit more about how these compare, but implied volatility is sort of that measure of how much movement the market expects. Vega is the change in the value of an option based on that implied volatility. In other words, if the market indicates changes in implied volatility, that's going to change the value of the option position. How much? Well, that's what Vega tells you. right? And so normally the analysis software that we use, and I'll show you an example of this, it will show you the change in value if there's a 1% change in implied volatility. By the way, IV is something you'll hear a lot, right? Doesn't mean intravenous, it means implied volatility. Okay, so here's an example of our analytical software. Simple single call in Apple. We got one contract of Apple. It happens to be a 170. It's currently at 174, so this is a slightly in the money call. Costs $8.75, but the number to look at is Vega. And what Vega is telling us is that there will be a $21 change if implied volatility changes by 1%. Okay? So this number, when you see Vega, it's normally how much what will be the value of your position if implied volatility changes by 1%. In other words, if there starts to be people buying up puts and calls because they think there's going to be price movement, that's going to drive those prices up. And when I back into that implied volatility number, if it increases by 1%, I'm going to make money on that. Now this can also be a negative number. Typically, if you have a positive theta number, you will often have a negative Vega number. And so it will affect you the opposite way. If implied volatility increases, you'll actually lose a little money. So this is a $21 increase in this case if implied volatility moves up. Now, I want to notice this as well. I want you to notice right now this position is at 0. It's exactly on the line. It's basically saying that currently we've not made money or lost money. We just put the position on. It's at 0. Now compare that to this next slide. This next slide, I'm able to, with the analytical software, I can simulate a volatility adjustment. So in this case, I pushed the volatility up by 1%, and sure enough, we're up $21.43, right? So you can see that how the Vega worked there, it was pretty much dead on. Of course, this is everything else being equal, no changes in price, no changes in time. It's just changing only in volatility. But that's kind of what Vega measures. It's the change in value if implied volatility changes. All right. Now, a couple other, I do want to show you one example of negative Vega. So this is an example, positive theta, negative Vega. So in this case, if implied volatility were to increase by 1%, we would lose $71. So kind of an opposite example. All right. Now, a couple things about implied volatility. So I was able to chart on the top of this chart. You have SPY. You just have the price of the S&P 500, very popular ETF. You guys know it. I pulled this one out because this is the COVID crash right here. So, you know, the stock market declined substantially during COVID in kind of the 30% range. So what happened to implied volatility when that happened? Well, implied volatility shot up, right? And this is pretty normal. Implied volatility often, not always, but often it moves up when prices move down. And especially if they move down fast, you often see this kind of a almost mirror image pattern. It's not 100% though. There are times, and I'll give you an example here, where price didn't hardly blip, but there was a pretty significant spike in implied volatility. So that happens, but you will see normally, and especially on the big moves, implied volatility just fairly commonly moves inverse to price. And if you think about it, that actually makes a lot of sense. When the market's crashing, people are really going crazy after trying to protect their positions, and so they're going out, they're buying up puts, they're selling calls, they're doing whatever they can to protect their position and to get ahead of what's happening, because it's happening. If you notice, and then again, this is common, is that this market dropped very fast compared to how smoothly and slowly it went up. So you'll see that as a pattern, is that when things really start to go down, it's not uncommon for people to just, I don't know what word to use, but maybe panic, right? I guess to some degree that's what's happening, and they're doing whatever they can, and so as a result, there's a lot of buying and selling going on, and that moves prices a lot. And when that happens, then there's more volatility, and the markets price these things up because they expect more volatility in the future. So it's something to be aware of, is that you're going to see spikes in implied volatility whenever you have these deep corrections. Now, one other thing I do want to point out, though, is that the market's most often wrong, and that's kind of an interesting thing. So here is an example. We have a correction. We have a spike in implied volatility. Implied volatility, by the way, is the yellow line. The magenta line is the actual volatility. This is the historic volatility. So the market thought things were going to be really volatile during this time. There was this little pullback, but it didn't actually occur. So the actual price movement, it just sort of moved on, and things really settled down. And this pattern that you see, where implied volatility exceeds historic volatility, is very commonplace. It's one of the reasons that we have an edge when we're selling, when we're a net seller of options, is because they're priced based on implied volatility, and the market's typically a little more fearful than it needs to be. Now, there are examples, like here's a very small example where implied volatility actually got over historic volatility, but it doesn't happen too often. Most of the time we have an edge because things are priced where the market thinks where people think the market's going to go. And so if you're a net seller of that premium, and then the reality comes in and it's not quite the way that is expected, you can profit from that. So it is one of the edges that we have as net option sellers to keep in mind, is that historical volatility typically or rarely exceeds the implied volatility. Okay, so there you have Vega, the change in the value of an option if the market indicates changes in implied volatility. It's again, the software typically shows you the value, the change in your P&L if there's a 1% change in implied volatility. That's Vega. I know that's one of the slightly more complicated ones, but as you see more and more examples and you play around with the software, and you'll sort of see how this works, and it will, I promise you, it will eventually make sense. Just know that implied volatility is a key part of the option world, and when implied volatility is high, options are expensive, and vice versa. When implied volatility is low, that means options have been cheaper, relatively speaking. The other thing about implied volatility to keep in mind is that it really only operates on the extrinsic portion, the extrinsic value of an option. So that's where it's going to affect you. If you're deep in the money, it doesn't have as much of an impact. All right, we are going to leave it there, and hope this has been useful. Thanks for joining.